I'm holding last month's shipping statements. Sales are down, profits are down, the music industry sucks.
Welcome to the U.S. Family Office Realestate.com podcast with your host, DJ Van Kuren. He's from the Arsenal Family Office. Each podcast is about real estate-related topics specifically for family offices. Now your host, DJ Van Kuren.
Hello, and welcome to the U.S. Family Office Real Estate Podcast. Today, I am very excited to have our guest, Richard Wilson with the Family Office Club, join us today.
Yeah, thanks for having me on here, DJ.
You know, a lot of people already know who you are, and because you've just done not only a great job for letting people know about some of the services that you provide, but also what you've provided and what you've given over the years to the family office space. And I think I've mentioned to you before that I came across you about 7 years ago or so, and it's just been, for me, it's been fantastic just to see all the things that you've continued to add on and some of the things that you provide. Could you just take a minute and tell us a little bit about, your organization and, your efforts in the family office space?
Sure. Yeah, we started the Family Office Club about eight years ago, and essentially we don't define ourselves as a conference provider or a family office database provider or a consultant to single family offices. We really define ourselves as serving the family office industry as a platform company and just treating each relationship with value, even if we can't do business with somebody for the next 7 or 10 years. That's completely fine with us because the industry is growing, and we want to keep our spot as the number one kind of thought leader in the family office space. So, essentially, I'm CEO of one single family office with $500 million in assets. I'm head of direct investments for 2 others. We have 14 centimillionaires and billionaires under contract, and we have 1,000 family offices plus in the Family Office Club. So our operating entities, altogether do about $11 million a year in revenue, but the main lines that our team spends day-to-day time on are our conference, data, training, and single-family office management businesses, and all of those are driven forward by just providing as much helpful education as we can in the space.
Great. Well, one of the things, too, that you really didn't mention too much of is that, you've gone around the world and you've talked to families from different countries, and you have for quite some time. And
right.
One of the things that I want to talk about today is that, we're the family office that I'm with, he's created his wealth through real estate. So we're very well tied into that space and understanding that space. However, there's a lot of single-family offices. Once they have an exit, they've got a tremendous amount of money. They're trying to figure out what to do with their money and where to put it. What have you seen and what are you seeing with allocations toward real estate for various families, and how are they going about it?
I see it as a very consistent allocation. Most families, almost all families, invest in real estate besides their primary and secondary homes. Typically, it represents, we found in our benchmark study, about 25% of their portfolio, but some families put 80% of their wealth in there, and obviously some less is a spectrum. But I guess inside of that real estate portfolio, we find that people first start with things that they can understand and they're familiar with. So an apartment building or a parking garage or a hotel, like things that they've used in their life. Most families who did not make their money in real estate or didn't make their money in manufacturing are not going into industrial real estate and playing the long game of buying a warehouse and trying to sign 7 and 10-year leases with manufacturing companies, for example, or buying an office building that has a lot more moving parts than, say, perhaps an apartment building. It does happen, but there's a spectrum of how easy an asset is to get into and how familiar an investor could be with it will make it so more and more families are putting those types of assets in their portfolios, which kind of pushes down cap rates as well at the same time.
Right. So how much, and what about a portion of funds? Are you seeing that families are using some of that allocation into the real estate funds, or is it more into the hard assets directly, whereas co-investments, in what capacity?
Sure. I see a lot of institutions doing co-investments, but only through the real estate funds they already trust, and they're not equipped to do full-on due diligence. They kind of lean on that. But when it comes to family offices, a lot of family offices do use still investment fund managers for diversification, for global exposure. But a lot of real estate is done on a class strategy, like an apartment building, multifamily class, or going after parking garages and doing that in one asset class of real estate, but doing it within 3 to 5 different cities, or maybe regional, or just cities that they think there's good job growth metrics, or just something else going for those cities. Or the family is very hyper local, like they'll invest in maybe 1 or 2 or 3 types of real estate, but maybe only in Miami. And for example, I've walked an apartment building one time. I'm going there again this afternoon to walk it a second time and hopefully put an offer down with a single family office that I work with this afternoon. And that investor does all of his work in only 2 cities, the city where he grew up and the city where he lives in now, because he knows where the development lines are, the zoning lines. He's got friends everywhere. It's just, you just get better flow when you have focus on either an asset class or a geography. So some of these things are, I want to make sure, like during our call today in this recording, that we don't say things there's like, oh yeah, I kind of knew that. But a lot of people trying to get deals done in the real estate space spin their wheels because they have some Denver project and they're taking it to people in San Diego that don't know the suburbs. They don't know Inglewood. They don't know what suburbs are good versus not, or what cap rates are trending towards, or something major that just happened in the city that you might not be aware of on the national level news-wise. So I just think that it's really easy to kind of know this stuff, but then not spend your energy on trying to get the real estate deals done in a very strict way that adheres to being super local in your approach to finding, co-investors or, counterparties for deals you're trying to put together.
So let's say you have a family office, and they're, Richard, I want exposure to real estate. I really don't know anything about it. I do know my local market, so maybe I do have a multifamily property. Maybe I don't. What do you suggest? How does one go about getting into the space, allocating into that space, because it is a good asset class to have part of? What would you recommend, and how would you suggest that they go about that?
I think most importantly, because some people might be like apartment guys or office guys and have made their money in that space. I'm, a single family office guy, and so I'm not stuck thinking about one asset class. And most importantly, from my point of view, it would be a long process of, like my new, this client, which he signs the agreement today, but he asked for the agreement 3 days ago. He's a $150 million net worth guy living in Idaho, and he reached out to us and said, I want to formalize my single-family office. I don't want to spoil my kids to death. I might want to buy a ranch and some real estate, maybe one operating business or 2, but I'm not sure. And I just don't know how much to give to philanthropy. And by the way, my trust and estate attorney is awful. So, like, when I'm working with him, I have my proposal and contract out to him that show, 15 different things we're going to address, but at the very beginning is creating a family charter document which says, what are your missions, what's your risk tolerance, what's your investment experience, where have you been burned in the past, what are your liquidity needs, what's the reality within your family, what are your priorities in terms of supporting future generations versus not, what have you done philanthropically lately, where do you spend your time, where do you live, where do you have business assets, what's the legal history of your family, etc. And you go through these 60, 70 questions, and then another 30 questions based on their answers, and you spend, a good half day or full day over several meetings getting that down first, because that changes everything else about answering your question. Like if somebody is looking for long-term preservation of capital, they might want very moderate debt, low risk, and they're fine with low cap rate, perhaps apartment buildings, but that's not right for everybody. And for some people, real estate development as a portion of their portfolio can make sense, and for other people, not at all. So for those of you that are like licensed financial professionals, they're saying, yeah, know your client, you got to assess the risk up front. But I think it is really important to get to know the client well, because not only does it allow you to, if you're working on 3 projects, maybe wait till that third one comes and not show them the first one if you know it's not going to be a fit. And you'll be more effective just showing families less deals, or showing counterparties, which could be other single-family offices, less deals, but have those be right in their strike zone. And just most people go around pitching all the time, and you get on a call, and it's a 45-minute pitch, and then people say, do you have any questions about the fund or about this deal? And everyone goes around pitching, and not many people really stop to listen, get to know someone, and then only bring them exactly what they ask for. And that's what we strive to do with our clients, is basically try to triangulate the geography, asset class, risk preference, the counterparty preferences, amount of equity debt on a deal, time horizon on the deal, taxes on the deal, et cetera. And if all those variables don't line up, then we're just not going to show that piece of deal flow to our client who's paying us to show them deal flow, but would rather show them nothing than show them something that's off because we either didn't ask the questions, or we've ignored them or forgot about them since we didn't document them during those first meetings.
What's interesting, and from what I hear with what you're saying, and then correct me if I'm wrong, but what I got out of that, what you just said, for a family office, is to say, okay, yes, allocation into different locations and investing is important. However, before you do that, you need to have a thorough understanding of what is it you want to accomplish. Do you have things in place? Are you organized? Do you have that foundation basically before you move forward into the investment? Would you agree with that?
Right, for sure.
Because I find that very interesting and very, very important, that I think any families that are listening to this, that they need to understand that, because I was with a number of families up in Aspen just the last couple of days, and it was really, they're looking for different investments. How do I find them? What's available? How do I make those decisions, et cetera, without having any of that foundation in place of goals, objectives, planning per se. And that can make a difference in what type of investments you're going to be making, regardless of whether it's real estate or whatnot. And that is very, I think, very, very valuable information. So now let's say that we get, so a family sits down, they realize that they feel good legally, they feel good with some of the things that they want to accomplish. Now they're sitting there, they knew the industry that they made their money in, maybe it was manufacturing, but they don't understand anything about hedge funds, they don't understand real estate, they don't understand, all these other different options, and more importantly, where to find these opportunities. Mm-hmm. So what could be, some things that you might suggest for a family that's sort of sitting there to say, okay, this is great, I feel good with what I have in place, and I'm sitting on all this capital, now what?
Right. I would say that between $30 million and $150 or $200 million, you might want to form a virtual single-family office, or a small, very leanly structured single-family office where you might have 1 or 2 full-time people, and then maybe a very high-power local CPA, or outsource service providers for due diligence and for other things, like, for example, maybe bringing you certain types of real estate deal flow that you've identified. And I would say that answer changes if you're worth, 200, 300, 500 million or more. You could for sure, afford typically to have, 4, 8, 15, 20 professionals on your team. And we have some clients that have, 60 plus professionals. And then I've met a billionaire family that has 1 full-time person, and they've outsourced everything else. And so I think part of that also, comes back to what the family's goals are. And some families who made their own wealth are very thrifty. They're very private. They don't like the padding of service providers. For example, one of our families, we're looking at buying a manufacturing business, and their very first step is going to be to cut out distributors and do the sales themselves, because they know that that distributor has the cost of selling, employing their 50 salespeople, but then that company has to make money or they won't be motivated to run their business anymore. So you're not only paying the cost of it, but for that convenience, you get charged a convenience fee because now you don't have to mess with it. The same with manufacturing something and you use a co-packer instead of doing it yourself. Sometimes it makes sense, but when the family is used to making their wealth through control, many of them want to build up their own team and be as autonomous as possible, so not paying padded fees and they're not too distant from what's going on with their money. And I think that's a really important point when it comes to control and why the movement is a little bit away from funds, is that if you're worth $100 million, you probably know a dozen or 4 dozen others that are also worth around that amount or much more. But most people in your life, 99.99%, are not worth more than $2 million or $5 or $10 million in most cases. And so what happens is that I've seen in their minds, that they see their wealth creation through their own control. Almost all of our clients are first generation. And there is a dilemma and a lowering of trust anytime they give up that control, because in their mind they're thinking, well, I've been a steward of my wealth and got it to $100 million. Now I'm giving it to a guy who's worth $1 million. If he was really, really excellent at real estate, why isn't he worth, why aren't they doing more? Something that's not said explicitly, but I feel it in meetings, and I feel that the control issue, like most of these families never will invest in something if they're worth $100 million plus. They rarely will give their money to some project and be like, yeah, we'll just be the minority right along. Some of them do that, but most of them want control if they're going into something either 50-50 or 51% at least. And I think it has to do with like their DNA and where they've gotten and how they're just rolling the dice whenever they hand over the reins to someone else and they don't have control at the end of the day. It just feels irresponsible to do so, I think, many times. So I think that's like a really important component to understand, is you really got to be transparent and, really build up a ton of trust to be able to ask for any type of control position equity-wise in a deal with these families on real estate.
All right. That leads me to a number of other questions, but first what I want to do is we're going to take a short break, and then we're going to be right back, and then I'm going to address those questions when we come back on.
Hi, this is Jim Freed, the host of Freed on Business on 880 AM The Biz in Miami, and you're listening to the U.S. Family Office Realestate.com podcast. The podcast provides you real estate information designed specifically for family offices. Make sure you check out USFamilyOfficeRealestate.com for educational information for family offices, including white papers, fact sheets, videos, and podcasts. You'll also find information on specific markets and assets, real estate cycles, tax-efficient real estate investing ideas, and much, much more. That's USFamilyOfficeRealestate.com. Information for family offices by a family office.
Hi, well, we're back with Richard Wilson of the Family Office Club, and today we're talking about family offices and not only their allocation to real estate, how they may look at things, but also investments in general. And Richard, right before the break, you were talking about some of the things that some of the families are looking for. I want to come back though to the question that, okay, that's if you find a deal and you're able to negotiate. But here you are, you're sitting there, you're a single family office. When there's a multifamily office, you have some of this infrastructure, I think, in place where they can start showing you different deals. But how do you go about, and how would you suggest, where do they find opportunities to even start looking at? And that's not even talking about understanding what they're looking at, right? So,
right.
Where do they go? Do they, do they go to conferences? Should they go to, talk to other families? What would you suggest? Because a lot of them are like, okay, where do I go? What do I do? And I'm limited currently in resources. And if you say that, well, you should hire a few people, like you mentioned, what type of people would you suggest that they hire or that they look for? Because after they have that foundation in place that we talked about before, now they've got to figure out where to invest their money.
Right. Yeah, I think that the more specific the family can be on what they want to invest in, the better deal flow they'll get. So if they are known for the family that invests in student housing, like one of the $100 million plus single family offices that was at our last event that I think you spoke at, that's based in LA, they're focused on student housing only. For Miami, I'm only spending my proactive energy on about a 1 square mile or 3/4 of a square mile semicircle that we're looking at, and we're not looking anywhere else, and we're like slowly spreading the word to some counterparties of what that terrain is to see who would be interested in helping us get access to more flow in there. So the more you can be known for something very specific, like parking garages or hotel development just in Jacksonville, Florida, or New York, the more you'll get that deal flow, because you say, oh yeah, we're a family office, we invest in real estate. It's like, okay, well, if you're plugged in, 400 other families that do that as well. So why would I send you any real estate deals? If it's a student housing deal, I'm sending it to the LA guy. If it's a hotel development deal and it's in New York, I'm going to send it to this other big real estate family that does a ton of like debt and equity investments in that space. So, I think that you have to find some angle as a single family office. You don't need to do marketing to attract clients. You need to do a ton of marketing to attract excellent deal flow. And this is partially why I enjoy working with my clients. Like one of my clients sold his business to private equity. We set up a single family office, and we called it the Miami Family Office. And now when you search on Google, we have like 5 or 7 of the top 10 Google search results, and number 1 comes up, the MiamiFamilyOffice.com. And so we get deals, typically more than 1 deal per day comes in from that positioning, and it's sweating and working for us every day. And yet it's not as good as being known as, you are the, hotel development guys that are most well known in Miami. But it's positioning to get us extra deal flow that's at least geographically relevant, and it's putting us in the line of good luck happening. So I try to do that as much as possible with my business. That's why we're based on this island of Key Biscayne, which has a ton of ultra-wealthy individuals and probably about 100 different family offices represented by the people who live here. It's also why I'm a member of EO, and I'm thinking of joining YPO soon. I'm a member of the Rolls-Royce Bentley Association here, which is it's a global organization. I use that to network to some extent. It's partially my motivation for running our conference business, like our Family Office Deal Flow Summit on Monday in Times Square. So we try to, it's a multi-part answer, but you need to position yourself in the marketplace to stand for something. And instead of a unique selling proposition, it's kind of like a unique, deal flow attraction proposition, or a unique, capital investment proposition, so people can keep you in mind versus just being one of 400, deal-a-day websites out there. Groupon was first mover, but how many others are just lost in the noise of that past trend because it wasn't unique enough and it just got overly crowded. And as the family office industry grows, there's going to be more of a need for positioning to get amazing deal flow, whether that's word-of-mouth positioning with 200 other single-family offices, and you go around telling everybody, send me your hotel development deals, but only if they're in New Jersey. Then eventually you're going to be getting those types of deals, and you're going to be getting them first, which means you'll be getting some of the better deals versus a deal that's already been looked at by 15 families who said, cap rate's too low, it looks like bad terms, et cetera, and you're getting kind of the leftover scraps from the families who are better connected and more well-positioned. So I think that's really important. And the last thing that I'll mention, because before I get too long-winded, is that anytime you can have an operating entity in the industry where you're trying to get deal flow, it's going to help you. If you're trying to invest in oil and gas, and you have an oil and gas services company that goes around and services some of the rigs and the oil drillers, then you're going to know about deals faster than if you're just an oil and gas investor. If you're a real estate investor as a single family office and you're focused in Brooklyn, you're probably going to end up doing better deals if you buy or start a Brooklyn, New York-based real estate brokerage and property management companies, because you'll have your feet on the ground, you'll have boots on the ground looking out for you on your behalf, and you'll just know the trends in the market. You'll know when it's softening, and you'll get deals that are superior as well. So there's multiple benefits of doing that. And that's why our business model isn't like, oh, yeah, we just, work with single-family offices, or we just, run conferences. It's by doing multiple things that we can be relevant in each thing we do, because we have all these different touch points with the different families and the trends that are going on and the headaches that they're having while trying to get high-quality deal flow.
All right, but so if that's the case, and you're talking about an operating entity and everything else, I mean, for many people, that's a whole other step, right? You're building another business, etc.
Right.
So what about rather than doing it yourself, maybe finding partnering with, let's say, a family who made their wealth in that area, or finding somebody that's an expert in that field to sort of piggyback on their expertise, their ability to do the analysis, the due diligence, etc. Are you seeing that happening among families?
Sure.
or with families?
Yeah, I see a lot of that happening. I think that the lower the wealth of the family, the more likely they are to accept a minority equity position. So if they're worth $10 million, $50 million, $110 million, they're much more likely to be okay with being a minority equity holder. The more that they're above 100, they're less likely to be okay. Some of them will do it just to move up the learning curve, but they'll only do it once. Or maybe they'll do 2 or 3 hotel deals with somebody as part of a learning curve and be 50-50, and maybe they'll pay 60%, where they should get 60% equity, but they agree to overpay a bit on the valuation, both parties knowing they are, but only have 50% equity because they're going to learn so much from the counterparty by operating that asset together, that's their tuition charge for the family, either finding the deal, structuring the deal, or being the primary force in running the deal. But there are a lot of families that work together, and
Yep.
I got an interesting email from someone the other day. They said, we want to speak at your event, and would like to speak at your event for free, et cetera. And I said, well, it's really expensive. So, if you're trying to put deals together and raise capital, we have to charge money. We only allow family offices to speak for free, and that's what keeps the stage really valuable. And he said something that was completely untrue and is really dangerous if you hear this and you don't know it's untrue. He said, well, every family office is trying to raise capital, and every family office is slinging deals and syndicating deals, and for sure that's not true. So for sure there is a ton of inter-family transactions getting done, and if you find a trusted partner, they might then trust you back on a different asset class, and it can be a great relationship. But at the same time, there's many families who don't want to deal with the counterparties, the messiness of it, and that trust curve. So it's important to know that not every single family office is also trying to raise capital, but with such a big industry out there, it's similar to saying, do businesses ever outsource their accounting to a third-party bookkeeping firm versus just having an in-house CFO and auditing accounting staff in-house? And of course, some people do because it's a big world out there. So there's all different flavors of family offices that will be open to different types of proposals and such.
Yeah, because we a couple of the points that you mentioned before is, you talked about deal flow, and one of the things that family offices definitely need to understand is that once you understand some of the things that you're looking for, then it's to let everybody know, that you can't, what
Right.
you're looking for and what you want. And we really our family office became part of the community just about 11 months ago, and the amount of deal flow that I've received for our family has been tremendous without really even trying.
Right.
One of the mandates that we have is oil and gas currently, and so it's a matter of, in a conversation, and I'll just even bringing it up, say, hey, if you know of anybody that has experience or opportunities in oil and gas, just let us know. And that simple sentence, creates a tremendous amount of deal flow, because people are like, oh, I'll send it. So we've had everything from funds come in to where, other families. And for us, on the oil and gas side, we do want to put a bunch of money to work, and we're used to having control, but it's such a specialized industry with the oil and gas that, we really do need an expert, somebody that's an expert in that space that can manage those operations. And as long as we can hit our returns, we're okay with giving up, some of those controls. But I do think that it varies family to family, and there's definitely people that, like you've mentioned, they've spent their whole life not only building their business and their wealth, but controlling everything. And that's very hard for people to change that are used to doing that, and they've proven to be successful. So I do think it's correct based upon, how that patriarch, how that family office looks at things. The other thing, too, though, is that we're talking primarily first generation with those comments. When you start getting into that second and third generation, they may not have that expertise on how to run a business. So if it's a matter of, if you mentioned, let's buy a couple hotels to learn and then we'll move on or to some type of business. If it's other generations, they're not gonna really know how to go about that. So I think that, and then you have to start looking at, okay, how do you get that expertise? How do you tap into that? Is it through a fund? Is it through a partnership, a co-investment, etc.? And that I think that will vary from situation to situation.
Right, for sure. There's never been so many formalized single-family offices before in the world as there are now. So it's not like there wasn't second generation, fifth generation, $400 million net worth families before, but most of them were not formalized under a single-family office. So their asset management was being done largely by private banks and big asset managers and investment houses, where now, for the first time, a large percentage of the wealth, or a growing percentage of the wealth, is being managed within a single-family office. And some of them do use a private bank or a trust company at the end of the day still, but a lot of them have more operating entities and real estate in the portfolio. And if the family's members of the next generation have different career paths and they're an English teacher, then it'll be interesting to see, with those types of families, how their portfolio changes and, what assets they liquidate or just find professional staff for, et cetera.
Yeah, I think that, one of the biggest things that I do want to mention that I think that family offices need to be aware of, and whether it's other family members or patriarchs or whatnot. I had one of my most favorite patriarchs that I met is out of Georgia, and they had a liquidation event which was probably $300-400 million, and spent 40 years building that business, and then had that big event. And we had a chance to meet, and we're talking, and I give him my business card, right? So he takes it, and of course he gives me his business card. And I look at it, and it has his name, and then I looked at his title underneath, and it said investor in training. And to me, that is such a powerful message on a couple of things. One is that, he's willing to accept that, hey, I'm learning this stuff. I don't know it all. There are very many different ways to go about it, and that I'm exploring and trying to understand different things. And being open-minded like that, I think, is going to serve him very, very well in the future. But it also shows that you do have to make sure that you do have that foundation in place. You try to get that clarity of what you're trying to accomplish, and the best thing to do is to speed up that process. Is to try to work with somebody that either, whether it's a family or organization that already has that expertise, or somebody like yourself that has expertise that they can bring to help that family to get to where they need to go. So if you've got a tremendous amount of information that families can gain from, and of course other events, and then you've got your services that you provide. If you could tell the audience how they can get in touch with you, how they can learn information, what type of information that could be available, and so that if they want to reach out to you, they can get in touch with you.
Sure. Yeah, I think there's just 3 quick ways that are all free or super inexpensive. One is just going to familyoffices.com, because they're pretty much says everything we do there, and can navigate that to whatever looks most interesting, and they have a free ebook, etc., event details. The second is if you listen to podcasts, we have our Family Office podcast, so I'd love it if you subscribe there or listen to some of those episodes. And then third is we spent about 700 hours writing this book called The Single Family Office, and it's on Amazon, and we sell it for 99 cents or $6, which is the lowest price we could sell it in paperback. So pretty much we're just giving it away, and we just found that is the best way to build relationships in this space, just give away as much value like you're doing on this audio interview. And so we always guarantee if someone buys that, you're going to like the book. You're not going to think, oh, it's a waste of my time. Like, what is this 20-page book? It's a 300-page book of 30 interviews with single-family offices and 40 videos recorded in 10 different countries on what's going on in the space. So we had a lot of fun putting that stuff together, and definitely appreciate the option just to kind of share some of what we're seeing in the space with your audience, and being able to hopefully expose them to some of those resources we created. So thanks for putting this together.
No, 100%. And just I do want to have one plug that, if anyone listening, try to tap into these resources. I mean, sign up for Richard's newsletter. Try to get on a distribution list for emails. Look into the information that he has. I mean, he's done an absolutely tremendous amount of work in the family office space over the years, and has provided a tremendous amount of value, and is an excellent resource not only directly but also through his staff and team and all the various places that you can find him online or in the bookstore, etc. So I do encourage people to explore that and to try to become a part of it, and realize that Richard is an excellent resource. So Richard, thank you so much for being on USFamilyOfficeRealEstate.com podcast. Very, very pleased for the time, and appreciative of the time that you took to talk about some of the topics that we talked today. And we'll look forward to seeing you soon at a family office event.
Sure. Yeah, I know we've ran into each other a couple times by accident in hotel presidential suites and cocktail parties and conferences, so I'm sure it'll continue to happen. And thanks for having me on here.
Okay, thanks so much. Bye-bye.
Take care.
Hello, and welcome to the U.S. Family Office Real Estate